So we're the LaDrew and Gatward Group. We're a team of licensed realtors with Oakland Realty, and we all are licensed in British Columbia to do trading services, and we primarily work with residential homeowners that are looking to buy or sell, and we're known for our expertise when it comes to new construction and condo pre-sales. So we're happy to have Maureen Young as our special guest tonight. She is a senior mortgage advisor with Dominion Lending Centers. She has years and years of experience, as she is our go-to person for all mortgage questions and our number one referral partner for our clients. We've been delighted with the way that she engages with people. Our clients have been really, really happy, and she's extremely knowledgeable. So if you have any mortgage related questions, make sure you ask her. So we've got a lot of topics to cover tonight. This is definitely an overview of everything real estate. But we do recognize that with first-time home buyers, there's a lot of hand-holding and a lot of questions that you will have. It's very normal for us to work very closely throughout the process with a first-time home buyer. We understand that there's quite a bit of education that we need to provide. So the first question is, should you get a pre-approval? And how does a pre-approval, how long does a pre-approval last for? Maureen, can you step in and answer that?
Absolutely. First of all, thank you for the lovely introduction. That was very kind of you, and super happy to be here. Should you get pre-approved? 100% always. Lots of reasons for that. One, I guess the biggest one is, let's start with knowing exactly what you're qualified for, so that when you're being shown properties, you know that the ones that you're looking at, that you're being shown, that they are in your price range. You also want to know ahead of time, how much is it going to cost me? Another benefit that comes from being pre-approved is getting your credit bureau pulled. I was working with a client last Friday. We were actually getting her pre-approved. We pulled her credit bureau, and she found that there was someone similar to her name who unfortunately didn't pay their bills, had terrible credit, and it was showing up on her credit report. So she's now gone back to Equifax to get that rectified. But it would have been terrible if the opposite had happened and she hadn't gotten pre-approved, had written an offer, and then all of a sudden found out that got to put the brakes on moving forward because her credit bureau had to get sorted out, just because her credit score was so low. So yeah, it's really good for a number of different reasons. The main one is, what do I qualify for? What are my payments going to look like? And I know that my credit is fine.
Mm-hmm. And I kind of had these in the wrong order here, but should you get a pre-approval for a pre-sale? We do get inquiries all the time from potential buyers that want to go looking at pre-sale opportunities, and they feel like they don't need a pre-approval because it's not going to complete for a few years. And we feel strongly that they should, in fact, get a pre-approval done, because we don't want people signing a legally binding contract if they don't have the capacity to buy.
Yeah,
They're taking
same.
on a lot of risk.
Exactly. Same thing. Even if it's the property you're looking at, it's not going to be closing for, say, 2-3 years. Absolutely still get it pre-approved, because if there is something that's not aligning up so that you're going to be able to buy that property you want to purchase as a pre-sale, I'll work with that person to put the steps in place so that when they get closer to time for completion, we know that they're going to be able to complete. Whether that's building up more credit, maybe they don't have enough credit, maybe the income is a little bit light, maybe they've just been working part-time jobs, so I can let them know, how do we structure that so that the lender's going to look at your part-time income, or maybe it's contract work, and again, you'll get approved for what you're looking for. So it really allows us to do some pre-planning so that we can make sure come completion time, there's going to be no surprises, and you'll absolutely be able to close on that purchase. The other thing too is if we were doing this in a rising rate market, I would always suggest let's go back out to the lender and let's get an extended rate hold. So that's going to be a rate hold that's longer than our typical 90 to 120 days. That can be anywhere from a year up to about 2.5 years. The rate is going to be a little bit higher simply because the lender has hedging costs or expenses because they can't use that money they're setting aside for your mortgage for anything else. But what it means again is that you know that you're going to have a mortgage. And I've seen some examples where that has been really, really beneficial. One, rates have moved up and someone would not have been able to have qualified because the rates jumped up so much. So they had this pre-approval, it protected them. We also will get the appraisal done at that point. So if anything was to ever happen to the value of the property, again, the appraisal is already done. If something happens to your job, again, you're protected by all those things.
Yeah.
It's no obligation. So it's nothing but a win-win for the buyer. And when we get within 120 days of the actual completion date, if nothing's changed that's going to compromise you going forward and getting another approval, we can always go out and shop the market again if it turns out there's a better rate, that kind of thing. One other thing I'll just add into why it's beneficial to get even that longer pre-approval is if the government jumps in and makes some changes to the mortgage rules. They have been known to do that. So if you've got that long extended rate pre-approval, you're essentially protected from any further legislative changes when it comes to getting a mortgage.
Had one little question from Gopal. We're gonna just wait until the end for our questions if that's okay with you. Because we got a lot of stuff to cover and I want to make sure we don't get too off track. But yeah, keep asking the questions. We will deal with them at the end here.
Yeah, absolutely.
Okay, so next is how much do I need for a down payment and what sources can I use?
Yeah, that's a great question. So the minimum down payment, if you're buying a home that you're going to be moving into or that a family member is going to be moving into, is 5% of the first $500,000 of your purchase price. So that's $25,000. And then the way the rules are today, it would then be 10% on the balance up to a purchase price of $999,999, just under $1 million. Right now, again, the way it is today, if your purchase price is $1 million or more, then your down payment would need to be 20%. So I referenced that's how it is today. We've got a couple big changes coming that have been announced. They're going to take effect December the 15th. And what those changes are is you can now take out a high ratio mortgage that's less than 20% down. As long as your purchase price now is under $1.5 million, you're moving into it or a family member's moving into it. So again, just like it's on the slide, up to 1.5 million versus what used to be $1 million. So it means again, 5% down on the first 500,000. And then on the remainder, the 999,999, you're going to have 10% down on that. So if you were buying for the maximum, let's just round it up to 1.5 million. Under the new rules effective December 15th, you'd need to have $125,000 as a down payment. If you were buying that same property, 1.5 million, and you were doing it today before those new rules kick in December 15th, you'd need $300,000 down. So that's a really, really big change for people. And I think that's especially a good change for our greater Vancouver market.
Yeah, no, absolutely. That's always the hardest thing is getting that first down payment on your first purchase.
100%. And if we can just touch on a couple more things on down payment. Source of down payment, that can be savings, RSPs, first home savings account, or gifts from family. So savings, that's easy. First home savings account, that's a great account that got introduced in April of this year. It means every year you can put in up to $8,000 into your first home savings account. What happens is when you file your taxes, that $8,000 you've put in, that's a deduction against your income, just like your RSP is. And then very much like a tax-free savings account, that money that's in your first home savings account, it accrues or earns interest tax-free. So when you find a home, you can pull your money out of your first home savings account and there's no income tax implications. There's also an RSP home buyers program, little bit different than that. You can contribute to your RSP home buyers program. When the money is in your RSP, it has to be in there for 90 days before you take it out. When
Mhm.
you take it out under that program, you're essentially borrowing the money from yourself.
Right.
So,
So with a first time home buyer savings um account,
mhm.
um like let's say you're going to buy a home this year,
Yeah.
it still makes sense to put some money in there because you're going to have some tax advantages this year.
Yeah, there's a couple things there. It absolutely does. The first home savings account doesn't have that requirement like an RSP home buyer plan does, where the money has to be in there for 90 days before you can take it out and use it to purchase your home. So you literally could put the money into your first home savings account one day and turn around and take it out the very next day.
Yeah, so that's huge. You're going to have some tax advantages just by
Yeah, and
doing
then
that.
just a little trick that I'll share with people as well. So you can put in that $8,000 every year. So let's say you get to December of this year, you don't quite have that full $8,000 to put in. Don't worry about it. Put something in, open up your first home savings account, $1,000. That works. Now, what that means is when we get into 2025, you've got the remainder of your $7,000 that you can carry forward from this year, plus you've got your $8,000 that you can put in next year. So you're maximizing your opportunity within that tax-free savings account. Sorry, it's not a TFSA, it's a home tax-free savings account.
Yeah, first time. I know, like the acronyms get to
There's
me
lots
too.
of them. Yeah. But that's a really great program. You can use your first home savings account and you can take full advantage of the RSP home buyers program. You can use both of those. So one does not impact the usage of the other one. With the RSP program, that program had a big change to it as well. So now if you've got money in your RSP, you can actually take out up to $60,000. Again, you're borrowing it from your RSP. You do have to repay it back. That's going to start in the second year of homeownership. And what you pay back is 1/15 of the amount that you took out. And what my office does is we always share all that information about how those programs work. And then we remind you when it's tax time, remember to pay back the 1/15 that you took out. And we'll tell you where you note that on your tax return, outline all the steps you need to do. So we'll make it as easy as possible to send you those reminders and just take you step by step about what you need to do so nothing gets missed.
So it's kind of like a free loan. You're not paying
Yeah, you're
interest or
borrowing it.
anything on it. Yeah, you're
Yeah,
borrowing it from yourself.
borrowing it from yourself. There's no cost, but what it does is it helps you to get into the real estate market, which is terrific. If it can top up your down payment, it's going to help you save on your CMHC premium too, because you've now got a bigger down payment. So we'll always, when we're working with someone, we'll go through all of the options about, okay, here's what you're telling me you want to put down. Could you do this? This is maybe where you could get the money from. Here's what the benefit is to you so that we can structure the financing in the very best way possible.
Exactly. Okay, so I guess we've kind of jumped the gun on my slides, but we'll
Oh,
we'll
sorry.
we'll get there. No, that's okay. That's the way things go. They go organically. So, as far as the actual mortgage pre-qualification goes, do they need to actually come and see you in person, or can this be done virtually?
We can do this virtually. We can definitely meet. We do a lot more virtual meetings following the pandemic, that's for sure. And for transmitting documents, we use a secure portal, so everything is safe and secure. So we can do it whatever way works best for a buyer.
Yeah, that makes sense to me. So, hey, this is just a list of the kind of things that you would um, expect to have to provide. Now, it may vary, of course, depending on the situation. Do you have
Yeah, and
anything to add?
that's a good list. Yeah, generally we have to prove employment. Where's your income coming from? So job letter, T4s, pay stubs, if you're an employee. If you're self-employed, either a sole proprietor or you have an incorporated business, then lenders are going to ask for 2 years of tax returns, 2 years of notice of assessments. If you're incorporated, also your financial statements. Also, if you are an employee, but say you earn some commission, or you work overtime, you get bonuses, so you have some type of variable rate income, then lenders will also ask either for your T4s or your tax returns. They're going to use that variable type of income, but because it's not guaranteed like your salary, they will do a 2-year average off T4s or tax returns.
Okay, great.
Yeah.
So can you talk about the difference between a pre-approval and a final approval? A lot of people just don't understand that a pre-approval is just sort of underwriting you, but the final approval is underwriting the property, if that's my understanding is correct.
Absolutely. And there definitely is a difference there, like you've noted, Lynn. With some lenders, actually, a pre-approval, they're not even looking at documents. They're looking at the credit bureau to make sure it's a minimum credit score. So we always have to send in a credit report with the application. And then you know what the lender's doing? They're holding the rate. They're holding that rate for 90 to 120 days. Some lenders do look at the documents, and some don't. Like I said, they just issue essentially a rate hold. But what's not looked at all in either of those scenarios is the property. So it's always important to remember when you're getting a mortgage, it's both the borrowers and it's also the property that get approved. So it does involve both of those.
So a problematic property could be something like a leaky condo, for example. You might not be able to get a mortgage on something like that.
Yeah, exactly. Or if it's a building where there just seems to be deferred maintenance and things aren't being looked after, so it's in a bit of disrepair. If it's not to code, something along those lines. So yeah, it's always important to remember it's both the borrower and the property that do get approved when you're getting a mortgage.
Okay, sounds great. So what happens if the interest rates drop while I'm pre-approved or after my mortgage is approved, but before I close? So I'm getting this question a lot. People want to wait until after the rates go down, but I'm telling them no, they shouldn't wait. They should buy now.
Yeah. And there's a sweet spot. I'll get to that in just a quick sec, or share what I think the sweet spot is. But let's say the interest rates drop, which is what they're doing right now. So you're pre-approved, but rates have come down. Don't worry, you will not miss out on lower rates. We'll make sure that you get that lower rate. And it's not just when you're pre-approved. So now let's say you bought a property. So now you've got your firm approval. You and the property again are now both approved. We're within 2 weeks of your completion date. If we see lower rates, two things will happen. We'll go back to your lender and ask them to match that lower rate. If they can't, we've still got time because we're 2 weeks before closing. We can move over to that other lender who has the lower rate. So you won't miss out. What we can do about 5 days up until your completion date, but we have to stay with the same lender, is if lower rates are available, work hard to get your lender to match that lower rate. And what I generally find, if we're within 2 weeks, most lenders will match rates. They've underwritten the mortgage at that point. They don't want to lose that client.
No, like wasted their time and their money.
Yeah, they'll work hard to match rates. So we really do stay on top of that for people, because that's a really important thing. It's also nice having multiple lenders. There's about 40 lenders as a broker that I have access to. So it's nice to be able to see what everyone's rates are doing and where those lower rates are and what they are.
So if you can touch on briefly, I don't want to belabor this point, but the difference between an open mortgage, closed mortgage, fixed, variable, adjustable, and amortization period, that's like kind of in the news right now.
Yes, it is. So open and close. Open means you've got a mortgage where it allows you to make lump sum payments or pay the whole thing off in full with no prepayment penalty. So typically those have a little bit of a higher rate. Generally, when someone is going to take out an open mortgage, it's because they're expecting some money to be coming in. They need
Mm-hmm.
some financing. They know they're not going to hold it for long because they'll be paying it off. That's the perfect person for an open mortgage. Most mortgages, on the other hand, are closed. Now, a closed mortgage still allows you to prepay extra. So you can make your regular payments, but you can also prepay with lenders. It's either 10%, 15%, or 20% of the original amount you borrowed. How that varies, some lenders, your extra payment has to be on your mortgage anniversary date. Some it has to be once every 12 months. Other lenders are much more flexible. You can make or contribute towards that extra payment on any regular payment date. So that's what a closed mortgage is. If you would pay the whole thing off, there's a penalty, but there's still room there where you can make extra payments every year and pay down your mortgage principal.
Yeah, and I had to sell a property a few years ago and pay a penalty. It was pretty significant, but at the time it made sense to do that. I mean, like
Right.
it had to be done. But obviously, you want to avoid that if possible.
Yeah, and that's one of the things when we're looking at a mortgage, we're always going to start with interest rate first, most important, but then we're going to break it down and we're going to look at the features and terms of those mortgages. And what I like to do with people is say, okay, here's all your features and terms. Let's put these in a priority as to how you think you may use them over the next 5 years, over the next 3 years. So that helps us to determine what mortgage product is best for a person, depending on what they anticipate their needs could be.
Okay, so next thing is the new insured mortgage rules. You did touch on this briefly, and so we can kind of skip this slide, I think. Essentially, it's allowing you to have a much higher mortgage, and still have it insured.
Yeah, and just one thing I'll point out, with the 30-year amortization, you do have to be a first-time buyer or it has to be new construction. You can be a repeat buyer and now get an insured mortgage up to just under 1.5 million, but your amortization would be 25 years. So they're saving that 30-year just for true bona fide first-time buyers or buying a brand new property from a developer.
Right. Okay, sounds good. And the best way to make mortgage payments. Like
Yeah,
I always paid bi-weekly. That was just the way I always paid my mortgages, but some other people prefer to pay weekly or semi-monthly or monthly. What do you have to say about that?
absolutely. Biweekly is a great way to make your mortgage payments. So, for example, you'd pay every second Thursday, means over the period of a year, you're going to make 26 payments rather than
Mm.
24 payments if you're paying semi-monthly. So you've got two extra biweekly payments. Because they're extra, those two biweekly payments will come right off your principal balance. When you start with a 30-year amortization, that's going to get your amortization reduced by about 3 years. Now, biweekly doesn't work for everyone if, for example, they're on a semi-monthly pay cycle. So in that case, make your payment semi-monthly, tie it into how you're paid, if that's what's comfortable for you. But we can work out your semi-monthly payment. So it's the equivalent of making bi-weekly payments. So it means your payment would just be a little bit higher, but you're making it on the frequency that ties in with your paydays, but you're achieving the same result as though you were making bi-weekly payments. Or
Hmm.
you could just say, I want to pay my regular payment. I want to make it semi-monthly because that's how I get paid. But I know I've got these opportunities to pay extra on my mortgage principal every year.
Yeah.
We'll run
So,
amortization schedules for people to show them if you make an extra payment, here's what it looks like. If you don't, here's what it looks like, so that you can see the benefit of making an extra payment on your principal.
mhm. Okay, so let's talk about first-time home buyer programs here. We talked about the tax-free home savings account, which I have a hard time saying that.
Yeah, it's a
Um,
mouthful.
yeah, so 8,000 a year and a lifetime limit of 40,000.
Yeah.
So do you know what happens if they don't buy a home?
Yes, you can actually Transfer the money that's sitting in your first home savings account if you haven't purchased a home, and you can put it into your RSP if you've got room.
Okay, so there's no downside here.
No, there absolutely isn't. But I think it's a really good thing to start. And as I said, if you don't have the full 8,000, just put in 1,000, start that first home savings account because you can carry it forward by 1 year each year.
Mm-hmm. Okay, and then your federal home buyers plan, and we talked about that already. This is how you can like basically lend yourself money by withdrawing it from your
Yeah, and
RSP.
they've really increased that limit from 35,000 a lot up to 60,000. If you've got two people who are buying together, they can each take out 60,000. So all of a sudden now you've got $120,000 towards your down payment if you're both able to take the maximum amount out. So that's a significant change.
That's $120,000 of interest-free money.
Yes.
That's
Yeah.
huge.
Yeah, no
Okay.
capital gains, no income tax, like nothing. You borrow 60,000 from your RSP, you have $60,000 in your hand to put towards your down payment. So it's a good one.
Okay, one thing we didn't talk about was your federal first-time home buyers tax credit. So that was raised up not that long ago to $10,000.
Mm-hmm.
So non-refundable tax credit, that is a line item on your federal annual income tax.
You bet. So if you bought a home, for example, in 2024, when you're filing your taxes next year for 2024, you'll be able to claim that tax credit on your tax return. So it's either going to reduce the income tax that's payable or possibly even generate a tax return. And if it generates a tax return, turn around and put that as a payment down on your mortgage.
Yeah,
So
exactly. So, property transfer tax. We have some pretty high property transfer tax amounts in British Columbia. It's currently 1% of the first $200,000 and 2% of the balance up to 2 million and 3% from the amount from 2 million to $3 million. That's paid on every single real estate transaction, but there's two really great exemptions here, and I'll let you take over now.
Yeah, absolutely. So if you fall into the category of being a first-time home buyer, which means you've never owned a principal residence, not only just in Canada, but it's got a really broad definition. They do say globally. If your purchase price is $500,000 or less, you've got zero property transfer tax to pay. Very hard to find a property that's $500,000 or less these days. So there was a change. So the way that the change works now, if you're a first-time home buyer, you are exempt on the first $500,000, and then you're only going to pay property transfer tax of 2% on the amount that's over 500,000. Before, the way it used to be is if your property was under 500,000, like I said, no PTT. Once it was over 500,000, you had to pay the full amount. You didn't get any kind of a break. So this is much, much better. And so you only pay the 2% up until over 500,000 up to 835,000. Once your price is over 835,000 to 860, there's a partial exemption that you've got. And there's a chart that we have that calculates out how much you're exempt and how much you have to pay. So that's a big improvement from what we used to have.
And there is a website, a provincial government website that has all the rules and also a calculator on there, which we can send to you as well.
Yeah, absolutely. It looks like you've got it down there, and I'm available for any questions on that as well, and I can share some more details. And then there is a second exemption for people. If you're buying a brand new home, then the exemption for having to pay the property transfer tax on a brand new home is now up to a purchase price of 1.1 million. And then if it's over 1.1 million, but less than 1.15 million, then again, it's a partial exemption that you've got. Now, for the new home exemption, you do not have to be a first-time buyer. You can be a repeat buyer. You get that exemption as long as it's a newly built home.
Yeah, and we see a lot of people taking advantage of that. I do want to point out there are some criteria you should satisfy yourself that you're going to be exempt. For example, if you are planning to rent the property out, you are not going to move into it, then you will absolutely have to pay PTT. You will not
And you also have
qualify
to
for.
be, yeah, sorry, I was just going to say you have to be a Canadian citizen or file taxes returns for the last couple of years. So there definitely is some qualifications to be considered a first-time buyer. So definitely something I can to also help with just to make sure that all of those requirements are met so that there's no surprises.
Okay, so Maureen, thank you very much. I'm going to have Adrian take over this little section. So Adrian Lee is one of our agents on our team, and these costs are somewhat general. When we work with people, we will dig into it and make sure that you have a better understanding of your situation.
Hi, everyone. So generally, the cost of buying a home in BC is that down payment normally it's 5% minimum. Do we suggest it? Not all the time. It all very depends on the situation. Normally, the higher the cost of the building, preferably put a higher down payment on. For property transfer tax (PTT), there are exemptions, and like Lynn has said earlier, the first 200,000, there's a 1%, and etc. We can tag the link to you guys later on again. And GST on all new builds, there is 5% GST. And then for mortgage default insurances, because right now there soon to be there's gonna be a new insurance cap to 1.5 million. So anyone buying any first-time home buyer getting a unit for 1.5 million or lower should get a mortgage default insurance to guarantee a below 20% down payment.
So maybe Maureen, you can jump in because you do have like a chart that can actually calculate that for buyers.
Yeah, so the way that the mortgage insurance premiums work, it's based on your mortgage amount and the loan to value. So, for example, if you're putting down 5%, so that means your purchase price is going to be $500,000 or less, you're going to be at the highest premium level, which is 4.1%. If you're putting down over 5%, but less than 10, you're going to be at the next premium level, which is 3.4. And then the premiums keep dropping down in increments of 5%. So there's a premium 5%, 10%, 15%. And the last one is when your down payment is 19.9%, but you haven't quite got to 20%. So the lowest premium that you would be paying is 2.4%. One detail with that premium, you don't pay cash for it. It just gets added on or rolled right into your mortgage. So it does make it easy. It's not an extra cash cost that you have.
Yeah, it just increases your total costs of over time.
Yeah.
Okay.
And then for title insurance, should you get it? I'll let Lynn answer this one for me.
Well, title insurance, you're looking at least $300 and up. It again depends on the value of your home. It used to be optional, but now pretty much every lender is now requiring it. It protects both the lender and also the buyer. It will protect against things like encroachments and title irregularities or even title fraud. We haven't seen a lot of title fraud cases in BC, but they have been in the news. In the last few years, there's been some significant title fraud cases in Ontario. And if those people had had title insurance, they would have had coverage. The other thing is you've got a lawyer. You're going to require a lawyer and or notary. We tell our clients to budget in about $1,500. There are some services that might cost more or less, but that should give you a good benchmark price in your budgeting. And then, of course, on closing, your lawyer is going to do a statement of adjustments. So the adjustments, we can give you some rough idea of what those will be. The biggest adjustments would be for property tax. So understand that property tax is the tax that is charged by the city, and it is an annual tax that the seller will have paid in full. So your lawyer is going to prorate that property tax, and you will have to pay back the seller, or there'll be an adjustment, a credit in favor of the seller for a prorated amount, and they base that on the adjustment date. So, for example, let's say the sale adjustment date occurs on June 1st. They would calculate how many days left in the year are on that date, and then they would create an adjustment for the amount that you owe the seller. Strata fees, often they will be prorated for the first month of strata fees. Sometimes they will actually charge a move-in fee or some other incidental fees as well. And then you could have to pay an inspection or other like associated costs like that. Insurance is also a mandatory requirement by most lenders, and we're looking at about $1,200, but it depends on what you're buying and the value of your contents and your claims history. So we do recommend that people get a quote for insurance early on in the process so that they're not blindsided by any costs. Maureen, I just have one question for you regarding title insurance. So you had mentioned to us previously 300 plus, but that there are different companies that provide that. So you would shop that around and get the best possible title insurance for clients.
Yeah, there's a couple websites where you can get a quote. What it really does come down to at the end of the day is which title insured does your lawyer or notary use, because they're the ones who actually do purchase the insurance.
Okay.
Yeah, I think that all of the companies are fairly close though in their prices. I just always like to give people a bit of a range so they know what to expect.
Okay, so I'm going to take over here. A lot of people are asking us what's happening in the market. Like, should they wait for spring or should they buy now? And we don't have a crystal ball. We don't know exactly what's going to happen in the future. There's certain fundamentals that we look at when we're making recommendations to clients. Certainly, we are looking closely at inventory levels, and they're extremely high in most cases. I was looking at Burnaby Brentwood, for example, and the inventory levels haven't been higher for the last 10 years. And we're seeing that in a lot of locations and product categories. So that gives buyers an absolute ton of choice, more than they normally have. Colin and I, we've been in this business for a long time, and we've seen inventory levels at 10-year lows where clients just can't buy anything because they're running into multiple offers. Right now, you can shop around and you have a choice of multiple properties to choose from. And this is not normal. This is unusual. So we think it's an opportunity. I mean, the other thing is that the interest rates have been coming down. There is another policy rate announcement coming up in October on the 23rd, I believe. And most of the analysts are expecting that the interest rate will go down another 50 basis points. So buyers, they have an opportunity right now, and you should be carefully looking at your situation. Downward pressure on prices. We are seeing so much inventory, a lot of stale inventory, some sellers that are reducing prices, And we're also seeing sales, a lot more sales below asking price. I have been successful putting in offers under asking price, and I think that there's opportunity for some lowball offers here if you're patient.
If you have a chance at some point, if I can, I'm happy to share just some information about getting a mortgage when rates are declining. So whenever you have a
Sure. No,
let me
jump right
know.
in. I'd be happy to hear it.
Yeah. So what I was just going to suggest, right in line with what you've suggested, this is a great time to be a buyer because there is so much inventory. You're not going to be in a multiple offer situation. There's people who are motivated to sell because they've had their properties on the market for a while. So one of the things sometimes people say, well, maybe I'll just wait till the rates come down a little bit more. So there's a couple ways to deal with that. One would be to take a shorter term mortgage rather than say your typical 5 years. So your mortgage will be up for renewal, say 2 or 3 years sooner. So that's one strategy. Another strategy would be to go with a variable or an adjustable rate mortgage. That way, as the rates come down, your interest rate will come down as well. If you have a variable rate mortgage, your payment is set at the time of funding, but as the rates come down, more of your payment will go towards principal. So you'll get paid off sooner. With an adjustable rate mortgage, both your interest rate and your payment will come down. So what that means is you're not going to miss out on those decreasing rates because it's hard to lock into, say, a 5-year fixed rate mortgage and then watch those rates come down. So
Yeah.
really, you may want to consider going fixed or variable. And then the other thing with a fixed or variable rate, a variable or an adjustable rate mortgage, the option you've always got is at any point in time, you can convert your mortgage over and move into a fixed rate mortgage. If that's really your ultimate preference is to be in fixed, you can do that, but do it once the rates have come down. And my office is always here to help share rate forecasts and rate information to help you decide when that works best for you. So you can kind of get the best of both worlds. Because what I always say to people is your purchase price is essentially carved in stone. That's not going to change. Your interest rate will change over the period of time that you own your home. So buy when the prices are right, so you're not paying more than you need to. And then let's put in the best mortgage product that matches what those conditions are.
Mm-hmm. So I guess if you're a first-time home buyer, you need to understand basic supply and demand. When there's lots of inventory, the buyers have the power. They can negotiate, they can shop around, they have lots of choice. They can put pressure on the sellers and prices tend to come down, and we have been seeing them come down. But as that inventory gets eaten up, as interest rates come down, more and more buyers jump in the game. We get into more of a balanced market. We don't know exactly what's going to happen, but we think that as we head into spring next year, we're going to see a lot more buyers competing in the market. So we think that the sweet spot to buy is right now until probably end of February. As we head into March, April in the spring market, we think that we're going to start seeing some changes. So if you're looking to buy in the near future, start paying attention, and we can talk more about market conditions in your target area because they do vary. Every little neighborhood has a different different stats, and we can dig into that and explain what's going on in that specific neighborhood with that product type.
That's such a nicer market to be a buyer in compared to, say, a couple of years ago.
Oh yeah.
Inventory was low and there was just so many buyers. And I can remember working with people for 6-7 months, and I can't tell you how many offers they had written. And it was hard for people because they were kind of in a position where they had to go in with no subjects. They weren't comfortable doing that. There was maybe, other offers going in, same thing. And it became a bit of a bidding war. So watch that happen. So I can see in hindsight that this really is a great opportunity because it is definitely a buyer's market.
Exactly. The other thing is if you are interested in pre-sales, a lot of developers are offering much lower deposit structures right now. I mean, in the past, it was not uncommon for us to see deposit structures between 15 and 25% for some of the premium towers. And now we're seeing like deposit structures at 10%, and some even at 5%, which as the market heats up, those low deposit structures are going to disappear. We are also seeing some buyers incentives on pre-sales that we have not seen before. Some really creative marketing and incentives. So if you're interested in pre-sales, like now is the time to buy. Again, lots of inventory, lots of choice. Now, a few years ago, you couldn't even buy a one bedroom if you wanted to. Like they just didn't, you just couldn't get one.
Yeah.
Where now you can shop around and there's one bedrooms all over the place. So I am now going to pass the torch over to Colin. He is my co-lead agent at the Ledru and Gatward group, and he's going to take over from here. I'm sure you're tired of hearing from me.
Never, never. So, yes, I just want to take you through finding and working with the right real estate agent for you, and really the importance of a consultation. So, at the Ledru and Gatward Group, we always, always, always emphasize the importance of having an initial consultation appointment, whether it's by Zoom, in person, on the telephone. We go through so much information that we really need to be able to assist buyers and sellers, and because we do it all. We do buying and selling, but really we ask an awful lot of questions. We have it doesn't have to be a long amount of time, but really it's so that we can understand what your needs are, what your wants are, what your budget is, which is always a huge one. We talk to you about, have you talked to a mortgage broker? Do you know what your budget is? What your risk tolerance is, what your desired move-in date is. There's so much information that we need to be able to assist you with finding the right property or selling your property, whatever it might be. So that's a huge, 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 very important part of our job, really. One thing we will discuss is designated agency. So we have always had what's called designated agency in BC. It means we have legal duties to you as our clients. You can choose to work with a realtor as a customer or as a client. Customer means we have no legal duties, no loyalty to you. As a client, we have full loyalty, so we only represent your best interests. Full disclosure, so we have to tell you everything that might influence your decision in a transaction. One of the very, very important bits is to avoid all conflicts of interest. So, there's lots and lots of situations in real estate where we might learn about a seller's position, or we might be in a situation where there are two parties that we are not representing directly, both parties, but that we have to essentially, we have a fiduciary duty to you to avoid any conflicts of interest and to disclose any information that we do know. Another huge one is confidentiality. So we have very, very strong privacy rules that we have to follow, and regulations. We are essentially, it's a document that we actually have you sign, and we are only allowed to share information with your permission, with people related to the deal. So sometimes I will ask a seller, what do you want me to tell people if somebody asks me why you're selling? Because I'm actually not at liberty to say unless you give me permission. Equally, things like your lawyer or notary, we often have a close relationship with your lawyer or notary and your mortgage broker. And basically, without that privacy consent, we can't share any information with them. And that hinders our job, basically.
Okay, next slide.
Next slide, our services. Huge, 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 huge. So our services basically start from the very beginning. Our consultation appointment, or even our discussion with you on the phone or on a Zoom meeting. And our services don't stop until you get the keys. And actually, even after that, we are in contact. So what I'll do is I'll just go through the list and kind of expand on some of the things. So recommend homes that fit your needs and budget. Of course, we find this out through consultation. One of the great things about working with us, especially if you're interested in pre-sale, is that we never represent a specific developer. We actually represent buyers. So we bring buyers to developers and to pre-sale developments. But what's great is that we're not connected with any specific one. So that really means we are recommending the ones that we feel fit your needs, fit the location you're looking for, most importantly, fit your budget. If you have any specific requirements, like I only want to buy south-facing perspective units, then that's what we do. We aim to only provide you with the homes that fit what you want. Next on the list, tour homes or sales centers. So we are there we make appointments, whether it's at open houses. We do attend with you open houses if we're able to. If we're not, then we can make appointments or we can recommend open houses for you to go to. And also on a pre-sale point of view, go to the sales centers with you. This is a really important part of our job, to introduce you to individual pre-sale developments that we think are good fit for you. We have huge connections and strong relationships with developers and with many of the staff within the sales centers. So we can really kind of nail down what works for you, really. Carrying on from that, because of those strong relationships, we often have insider or VIP access and access to special pre-sale events. There have been situations in the past where we have actually gotten access to specific pre-sale projects weeks and weeks, if not months, before other realtors and many months before the public. So it's one of the real benefits of choosing to work with someone that specializes in pre-sale, is that insider access that we have. Due diligence on your purchase. So whether you're buying pre-sale or resale, there is a lot of information that we review and we ask you to review. And really, we look out and represent your best interests. So we're looking through, if it's a resale, we're looking through huge amount of strata documents, depreciation reports, engineering reports, strata meeting minutes, all of that. We do ask that you do the same. And then often what we do is we'll come together and you might have some questions and that we can also expand on what we've read. If it is a pre-sale purchase, then there is a huge amount of documents, and that actually is the next point. Review all documents, contracts, disclosure statements, strata documents. With pre-sale, it's a very, very different beast than resale. The contracts are different. Everything about the process is different. So we are there. We are specialists. We have looked at hundreds and hundreds and hundreds of contracts and disclosure statements, and we understand them. So we are there to guide you through the whole process. And I think that really is one of our huge roles, is as guides. Because we have the expertise and the specialization and years of experience, we are there to guide you through the whole process. And that's not on this list, but typically buying and selling can be incredibly stressful. And that's what we try to take away some of that stress from you. I'm going to say you won't get a bit stressed. However, our job is to make it as stress-free as possible. Market price analysis. So say if you are, just for an example, you are buying or selling a property, we will look at all of the data that would influence either the sale price, the listing price for your property, or the purchase price. And that means that by looking at those numbers and those statistics of recently sold properties, we can provide you with the best advice. Contract terms and price recommendations, that kind of leads into it, really. Again, we're there as guides. We understand the terms of a contract, and we'll explain all of that to you and make recommendations on pricing, whether it's listing or buying. A huge part of our job is negotiation. As Lynn mentioned, and Maureen mentioned, actually, it's depending when you're buying, depends on how much you can negotiate, especially in pre-sale. And well, no, the whole thing. Resale and pre-sale purchases involve a lot of negotiation, and we are professionals in the field. That's part of a very large part of our jobs, is negotiating with other agents and with developers. Attend inspections and deficiency walkthroughs. So if you're buying a resale, we always recommend that you do pay for a professional inspection. We would be there to guide you through and be there when the inspector goes through all of the findings. If it's pre-sale, then we are there at your deficiency walkthrough. This can be 3, 4, 5, even 6 years after you've bought. So we don't stop working for you by writing a contract. We're there for the duration. And again, we've done a lot of deficiency walkthroughs. We understand what is good. We've done them through many, many developers. So we have quite eagle eyes as to what is deficiencies and what is not, and we will help. I think the other thing with that as well is it's very exciting when it's your home, and we can come in and do a deficiency walkthrough with a different set of eyes. We can be very objective, let you enjoy the space and the new kitchen layout and all of those things, and we will be there to do the flagging of any deficiencies. Again, we work with a lot of different people in the real estate industry, so we can recommend a wide variety of service providers. We do have a resource list on our website, but we do try to tailor it by location for people. So just ask, essentially, and we will make recommendations as time goes on, whether you need cleaners or you need a painter or you need a handy person or whatever it is, we can recommend to people. Again, as I mentioned before, we will liaise with your mortgage broker and your lawyer or notary. Again, as long as you've given permission for us to do so, that's also part of our job. And then the exciting bit when you get your keys. So possession, we are there. So whether it's a pre-sale, and again, you bought years and years ahead of time, we're there for that key handover, the final date when you get to enjoy your new home or your new investment property. Or if it's a resale, then the exciting time that you can move into your home. We're also there after that. Our job doesn't end. We are there for follow-ups and reminders about things like reporting your warranty deficiencies to the developer. We're there to do those reminders. And on to the next slide. Am I doing this,
I just
Lynn, or
want
are
to
you
jump
doing
in. I just want you to, I just want to jump in briefly because we're way over time here.
Yeah.
So
Okay.
I think we should just like blast through this, but yeah, you can
Yeah.
do this section.
Okay. So pre-sales, resales, assignments, what are the pros and cons? I'll just go through them quickly as Lynn mentioned, we're going a bit over. So pre-sale advantages, you get a brand new home. There's no wear and tear. You get the newest design and architecture, the latest building codes, technology, and eco-friendly features. You get the benefits of VIP access. So you get the best pricing, best selection, and any perks or incentives that we can offer you and the developer. You get customization. So usually you can choose your color schemes if you're buying at the initial sale, and even, a little bit further down the line. Sometimes there are upgrades on offer. And if you do have any specific requirements, we will, of course, ask the developer. There is a huge potential for appreciation in a rising market. Resale condos can appreciate in value before they're even built. So if you're buying something that's, not going to be finished in 4 or 5 years' time, in a rising market, there's a lot of potential for growth in there. Great for time for financial planning. So again, as they can take many years, you have a lot of time. You can be saving for a larger down payment deposit when completion comes up. Warranty coverage. So pre-sale condos come with the BC 2510 new home warranty. I won't expand on that, but that's one of the huge benefits of buying brand new. And also, if you're buying within that exemption, and it's going to be your primary home, then you do get the property transfer tax exemption. Disadvantages, GST. This is always one that everyone mentions, and it is, so for brand new, you are having to pay 5% more, and you pay that at completion. It is worth noting that this can be included in your mortgage. So you don't have to have extra money in the bank waiting for that 5%.
Maureen, can you double check that? Because I'm pretty sure that on my last mortgage, they didn't include 100%. It was something like 80% of the GST was rolled into my mortgage. I'm assuming it varies.
It should have been 100%.
Yeah.
So if your purchase contract reads, just for example, 600,000 excluding GST, what we're going to make your purchase price and what the lenders will accept is 600,000 plus 30,000. So we would work off of 630,000. The down payment would be based on that 630,000.
Okay, awesome.
Okay. Developer variability. Yeah, this is huge. This is, I would say, we always say that actually when you're buying pre-sale, the developer is probably one of the most important things. Ask us. We've worked with so many of them. We always guide our buyers to buy from the best developers because we want you to have the best experience, basically. Complex contracts. Yes, pre-sales are very complicated, and careful due diligence is necessary. Again, we go through hundreds of contracts, so we understand the complexity, basically, and can explain them to you. Market fluctuations. Buyers are committed to purchasing the unit at an agreed price, regardless of the market price on completion. This can pose risks in a declining market. So pre-sale is a promise to buy the unit at completion. And again, the price can change. It can go up and go down. So in a declining risk, that can be a disadvantage.
The market price, but not the contract price.
Correct. Yes. Yes. Contract price is given. You've signed a legal contract that says you are buying at that price. Uncertain timelines. We really experienced this a lot during COVID. Construction projects can often experience delays. I have, interestingly, even during COVID, had a few developers complete early, surprisingly. It does happen. It's rare. Usually can be a small delay, if not, especially during the pandemic, a very large delay, which could be years long. Another disadvantage, deposit tie-up. So you are putting down an amount, a percentage of your contract price, which is being tied up for several years. And buyers do not typically earn interest on this deposit. There are some exemptions. There is an incentive from a couple of developers at the moment that are offering to pay not a specific, they're offering to pay a percentage amount on your deposit. That's not normal, but it is an incentive we are seeing with a couple of developers. Another disadvantage, you can't go into the actual space and feel what it looks, and feel the space and see what it looks like. You can't actually go in until the deficiency walkthrough. So you might be waiting years. You are buying it based on floor plans, renderings, building models, and hopefully a display suite, which may have not been your floor plan, but you would know what the finishes were like. So existing homes, resales, pros, generally these cost less per square foot when compared to new construction. And that is because developers do build in future value when you're buying pre-sales. It varies from location to location, neighborhood to neighborhood, but generally a resale home is less money. It's also because it's not brand new. You are buying something that somebody has lived in. Prices are negotiable. Yes, that is typically only with resale homes. We are seeing that a little bit with pre-sale. Again, extraordinary at the moment because it is a slow market. Typically, you don't see that in pre-sale, but you do in resale. They actually exist and can actually physically be seen and inspected, walked into. You get the feeling of what the space looks like. You know what the windows look out over. GST has already been paid. Usually, there are some exemptions. Ask us. They're only when a property hasn't been occupied, but we can advise. Another pro, new home warranty is transferable if the building is under 10 years old. So that BC 2510 is transferable to the new owner. Fast completion is possible, and you know when the completion will be. With pre-sale, you don't. It's a estimated time. Existing resale homes, you know when that is. Cons, wear and tear or possible renovations needed, varying building conditions. I suppose to expand on this a little bit, older buildings may have deferred maintenance. I think Maureen mentioned this when she was discussing. So you may see issues come up in older buildings. You also typically in resales, you have higher strata fees. And that's because they have been operating for the length of the building. It could be a 10-year-old building, it could be a 40-year-old building. So your typically strata fees go up as they get older because of maintenance and things that need replacing. Another con, you must review all the strata documents. So as I mentioned, we will be there to assist, but there are a lot of documents, often hundreds and hundreds of pages to go through. We always recommend an inspection, and that's just so you can see what the actual condition is of the property at that time. If tenanted, there is a 3-month notice period required to get vacant occupancy. And that means your completion date is pushed out. That is new. It was 2 months previously. It is now 3 months. This could have some implications with your financing. So, and that's another reason why we are in regular contact with your mortgage broker, so that we make sure that we can fit into all of the required dates. Another con, in a hot market, you may have to compete against other buyers, so you could be in a multiple offer situation.
Okay. Assignments.
So, pros, there's lots of inventory and distressed sellers. This is especially at the moment. There are buyers, the original pre-sale buyer which bought the contract, they are not able to complete, or they may have moved to another country. They don't want to complete. They are in a different job. Their financing situation is different. So they are willing to accept being sold at cost or below cost. So there may be an opportunity for a bit of a deal here. Less waiting, because typically assignments are only done after, well, they're always done after the pre-sales in varying time periods. Often you'll see them when the building is coming up closer within the last year of completion. So they will be under construction. So you'll have a better grasp of timeline. Cons, there is no sales center. So the sales center will have closed, and you need to make a decision on buying an assignment based on marketing material, the existing original pre-sale contract, and the disclosure statement. Typically, if you're buying through an agent that specializes in pre-sales like we do, we will have lots of photographs of the presentation center, display suites. We can help with providing more information perhaps than some others may be able to. Another con, which is a big con, is they can be cash intensive. You basically have to pay both the lift and the original deposits. So when you're buying a pre-sale where the seller is making a profit, that means there is a lift. It's the amount that they are selling for above the original contract price. And essentially, when you're buying an assignment, you have to reimburse the original deposit because the developer holds that. So what you're doing is you're paying the seller the amount that they have already given to the developer. And in some cases where there is a lift, you have to have cash for that as well. They can be complex to negotiate. They are incredibly complex. I'm going to scratch out can be. They are very complicated. A lot of realtors do not know the ins and outs of assignments. They may have never written an assignment contract. We have done a lot. So we can actually provide them advice. And we have been known to help the other party actually write the contract because they are very complicated. And developers require them to be filled out a certain way. Last con, they are usually not advertised on the MLS, so they are harder to find. Again, working with someone that specializes in pre-sales, we likely have access to more assignments than somebody that doesn't specialize in pre-sale, because again, developers often don't allow them to be advertised on MLS.
Okay, we're getting close to the end here. Q&A
Yay.
session. So this is your opportunity to ask us some questions. And I do have a couple in the chat. Gopal's already left, and so I can't ask him what he meant here.
Okay.
basically the question was, can you invest the money from the first time savings account, for example, buy GSCs or invest in mutual funds? That is more a financial planning question, but I believe you can if you set up account on like Wealth Simple or something like that.
Yeah, that's absolutely correct. So if you go into, for example, Wealth Simple, they were actually one of the first people who had first home savings accounts available. Really easy to set up an account with them. But yeah, you can choose where you want to invest that money. What is your risk tolerance, that type of thing. So there is some flexibility there. Yes.
Okay, well, Maureen, another question from GoPull here. It says, what's the GDS/TDS percentage required to get a mortgage with an A lender at LTV of 80%? Does that
So
mean something to you?
That's my language. GDS is gross debt service ratio.
Okay.
And TDS is total debt service ratio. So GDS, we'll use the acronym. That's the percentage of your mortgage payment, principal and interest, your taxes, your heat, and half of your strata fees if it's a strata. And what TDS or total debt service ratio is, it's those same things, those housing costs, but we're going to include car loans, personal loans, lines of credit payments, and 3% of any credit card balances. So those are the two metrics that all lenders use. If we're looking at a maximum mortgage of 80%, so it's not an insured mortgage, so we don't have to follow the insurer guidelines. We only have to follow the lender guidelines. So some lenders, it's a maximum of 39% GDS, meaning your mortgage payments, half your strata fees, property taxes, and heat can be no more than 39% of your gross annual income. Those things, plus any other financial obligations you have, can be no more than 44% of your gross annual income. Now, having said that, that's one group of lenders. There's another group of lenders out there where we can get exceptions. So let's say we don't have a lot of exceptions on the mortgage application. Everything else is good. It's fitting all of those boxes. It really just comes down to some debt service exceptions. We can get those with a certain group of lenders. Who those lenders are, those are going to be predominantly the banks. And the reason they can do that is they're what we call balance sheet lenders. They're lending out their own money, so they can kind of make their own rules. So they can say, okay, you know what? We like all these other things about this application. It looks good. They're strong, great credit, good income. They've got some cash for a fallback position. Yeah, we're going to let them borrow more than what our guidelines are because of the good things that we see on the application. We're comfortable. Maximum total debt service ratio, or TDS, is probably going to be about 50% for a strong borrower.
Okay, sounds good. Another question from Tony. Where are the assignments listed if not MLS? Well, they're just not listed. So the developers have control over how you can market an assignment listing, and if they will not allow you to advertise, then that means if it's my client, the seller is my client, then I need to find buyers through other means. I will post on my website, but I might not be able to use any of the developer's marketing material. I might not be able to put an address on there or even name the development if they're being really strict. And I will have access to certain inter-office like chats and things where I can advertise it to my colleagues. There's also some Facebook groups that are private real estate agent assignment focused Facebook pages. So like there's ways of finding them, but ultimately when my client tells me that I want this and I'm a serious buyer, well, then I will start knocking on doors and trying to find it. I'll call other realtors that I know deal predominantly in pre-sales because they're the most likely that they're going to have those kind of listings. And it's just like digging around until I find what my client's looking for. There is no easy way to find them. There's no database, there's no MLS system. And you can say a lot of the same things about pre-sales. Pre-sales are almost never listed on MLS. You have websites like ours, Nest Pre-sales, where we try to put every development we can find out about on our website, but there's no database that shows availability or pricing. So we have to literally phone and phone and phone and phone and phone every developer until we get a list of available units that fit your needs and your budget. That's how we do it. There's no easy way. And that's why pre-sales agents that specialize in pre-sales are very much a niche. Not all realtors handle pre-sales because they don't want to.
It's a lot of footwork, especially if you want to go preview the place before your client, so you can tell them more information ahead of time.
Yeah, sometimes you just have to do that depending on what they want. So that starts with the consultation. We are happy to do the groundwork and all the running around for you, but we won't do it until we know that you're a qualified, serious buyer and you've had a consultation with us. We need to know more about you and what your needs and wants and your budget are before we can spend the time finding those products for you. So I think we've got our little questions on here. I had a couple more from somebody that couldn't attend today. So quickly, maybe we can deal with these. One was regarding gifts, Maureen. You hear about the bank of mom and dad. A lot of parents are helping their kids get their foot in the door when it comes to real estate. But I understand that most lenders, they consider gifts to be different than money you've saved up on your own. So what advice can you give first-time home buyers that might be expecting some help from a relative?
Yeah, absolutely. We're seeing more gifts than we've seen in the past number of years, which kind of makes sense. So all lenders will accept gifts. There are a couple requirements, and they really stem from anti-money laundering regulations, which is always about understanding the source and the ownership of the money. So gifts should be coming from immediate family, mom, dad, brother, sister, grandparents, that kind of thing. We can with some other lenders, cousins, we've done that before, but that will be not necessarily every lender. That sometimes is more a credit union thing. Their definition of family is a little bit broader. What all lenders will request is a gift letter. So we'll provide that to the buyer. That's going to be signed by the donor, the person giving the gift, and the borrower. And then the second step of that is
Oh no, I hope I haven't lost her. Okay. Well, hopefully she comes back in. I think we're pretty much done anyways.
They should be in the borrower's bank account 30 days before completion. And we'll take everyone through all these steps and the timeline so that everyone knows what they need to do by what date. Couple lenders out there will ask to see the donor's bank account. That's not with every lender, though. That is going to be lender specific. And we'll go through all of the details, but gifts are accepted by all lenders. We just will make sure we're following their guidelines.
Okay. Another question from Canadian first-time home buyer that is not currently living in Canada. And so I don't know, are you seeing that lenders are requiring higher down payments in that situation now?
Yeah, so if they're a Canadian citizen, but they're a non-resident.
Yeah, that's correct.
The best lenders for those are going to be one of the banks. So typically, you're probably going to need 35% down in that scenario. There are some lenders, if you're working with a Fortune 500 company, so one of the big global companies, there's a list of Fortune 500 employers. In that particular case, you can do 20% down.
Okay. Okay, and then of
So,
course,
depends on the situation.
if they're planning on moving back, then in order for them to get the PTT exemption, they would need to be back in BC before completion by at least, I believe it's a year,
Yeah, and
in
then
order to qualify for the exemption. There's all kinds of little rules. So
how
it
they
really,
file tax returns, that kind of thing. So we want to dig into that. So again, we're giving advice so that there's no surprises to make sure that they are indeed exempt from PTT.
yeah. So otherwise, you might have to pay all the GST and the PTT, and some of the first-time home buyer programs may not apply depending on your situation. So it's really important, if you are a non-resident at the time of purchase, that you dig into that before you make a
Yeah, we want to
decision.
do some planning, and very much like you do in your office, about asking the questions and really understanding your client and knowing all the details. We do exactly the same in my office, so that there are no surprises that are going to come up down the road. We want to make sure we've covered everything off. And if there's anything that needs to be addressed, we've got time to address it, so that everything goes smoothly.
Okay, so Maureen, you've been awesome, so full of knowledge. I think I closed out my little screen show, but I will just say goodbye to everyone. Please reach out to us. I will send everybody a copy of this video. And if you'd like to get in touch with Maureen, I will also make sure that I include her contact information. She's an absolute gem, a wealth of knowledge, and it
Thank
would
you
be
very much.
well worth your time to call her, because she knows everything about mortgages. And what do you have, like 25 lenders that you can place people with?
Well, you know what? The number has actually grown. It's about 40 now.
Wow, so that's huge. So she's going to shop around your mortgage to find the absolute best fit for you. And yeah, you can't find that everywhere. So thank you very much, Maureen. And
Thank you for the opportunity. I appreciate it.
okay, well, everybody have a great evening, and reach out to us if you have any questions.